In this lesson, we'll break down the balance sheet into its three core parts: assets, liabilities, and equity. We'll also see why the balance sheet is called a snapshot, not a story over time. By the end, you'll be able to read the basic equation, identify current and non-current items, and understand what the sample statement is telling us about a business's financial position. The balance sheet is built on one equation: assets equal liabilities plus equity. That means everything the business controls must be financed by borrowing, by owners, or by both. If the statement does not balance, something is wrong in the recording. The source also reminds us that accounting is standardized by rules such as GAAP in the United States and IFRS in many other countries. So the equation is simple, but the reporting standards behind it are strict. Assets are items owned and controlled by the entity that have value and were acquired at a measurable cost. The source splits them into current assets and non-current assets. Current assets are expected to turn into cash or be used up within 1 year, such as cash, accounts receivable, inventory, and prepaid expenses. Non-current assets stay in the business longer. The source highlights property, plant, and equipment, or PP&E, which can depreciate over time because of wear and tear. In other words, assets are the resources the business uses to operate and earn money. Liabilities are debts owed to outside parties, called creditors, in return for money, goods, or services. Current liabilities are due within 1 year. The source names accounts payable, bank loan payable, and estimated tax liability. Long-term liabilities are obligations that will not be paid until at least a year has passed. A bank loan can appear in both places if part of it is due soon and part is due later. So liabilities are not just debts in general, they are debts organized by when the business must settle them. Equity is the residual interest in the business after liabilities are accounted for. In the source, equity comes from two main places: paid-in capital, which is money supplied by investors, and retained earnings, which are profits kept in the business instead of being distributed. That means equity is not cash sitting in a drawer. It is a claim on the company's net assets. For a proprietorship, the business may have only one owner, but the equity section still separates the owner's stake from the company's liabilities. The current versus non-current split helps you judge timing. Current assets should be converted into cash or used up within a year, while non-current assets last longer. Current liabilities are due within a year, while long-term liabilities stretch beyond that. This timing matters because a business can look healthy on paper but still struggle to pay near-term bills if current liabilities are too heavy. So balance sheet reading is not just about totals, it is also about when cash moves in and when obligations come due. The source also points to double entry bookkeeping and the dual aspect concept. Double entry means every transaction needs at least 2 entries so the balance sheet stays in balance. The dual aspect idea says that if total assets change, there must be a matching change in liabilities, equity, or both. A simple example is buying equipment with a bank loan. Assets go up because the business controls the equipment, and liabilities go up because it owes the loan. That is the logic that keeps the equation balanced after every transaction. Now let's read the sample balance sheet from the source. On the asset side, current assets include cash, accounts receivable, inventory, and prepaid expenses. Non-current assets show property, plant, and equipment, less accumulated depreciation. On the other side, liabilities and equity are grouped into current liabilities, long-term liabilities, paid-in capital, and retained earnings. The important check is that total assets equal total liabilities and equity, 2050 on both sides. That is the practical test of a correctly balanced statement. Several accounting concepts shape what appears on the balance sheet. The money measurement concept says only items that can be expressed in monetary terms go on the statement. The entity concept keeps the business separate from the owner's personal finances. The going concern concept assumes the entity will keep operating indefinitely. The source also contrasts cost and fair value. Cost is the original amount paid, while fair value is the amount an item could reasonably sell for in the marketplace. These ideas explain why balance sheet numbers are structured, not random. To see this in the real world, look up a public company balance sheet through Google Images or an annual report page. Even when the design looks different, the structure is familiar. Assets on top, then liabilities, then equity, with totals that must still balance. Use the image to trace the same 3 questions from the source. What does the company own? What does it owe? And what belongs to shareholders? That visual link makes the textbook template feel like a live business document. A balance sheet gives a glimpse into the health and composition of a business, but only at one point in time. It helps you see the short-term cash position, the debt load, and how the company is financed by owners versus creditors. High current assets may suggest more near-term flexibility, while heavier liabilities mean the business owes more to outsiders. The key is not to read one number in isolation, but to read the relationship between the sections. The balance sheet is a map of financial position, not a full movie of performance. Here is the takeaway. Assets are what the business controls, liabilities are what it owes, and equity is the owner's residual claim. Current and non-current categories organize timing. Double-entry bookkeeping keeps the equation balanced, and the sample balance sheet shows how all of this appears in a real statement. If you remember just one line, remember this: assets equal liabilities plus equity. That single equation is the foundation of the balance sheet.